So do you want to invest in real estate and have that income producing property, but you don't have a lot of money to do that? I'm going to show you ways to invest in real estate without owning property. That's what I'm talking about today. Stick around. Hi, welcome back. My name's Joe Brown. I'm a real estate agent with Century 21, List with Beggins, located in South Tampa. Thank you so much for being here with me today. So I do focus on commercial real estate. And one of the big things with commercial real estate is investing in real estate. And that happens in the residential side as well. And if you're talk to financial advisors and wealth advisors, they say you want to diversify your portfolio. You want some money in cash, you want some money in bonds, you want some money in stocks, and you want some money in real estate. But let's face it, when you think about real estate, it's, okay, let me buy this house that I can rent and get the rental income. Or if you think at a bigger scale, let me buy an apartment building, right? Well, who has, just for a house, an extra $400,000, right? Or for an apartment, a couple $1 million. Well, there's a vehicle out there, vehicles, called REITs, R-E-I-T-S, which is Real Estate Investment Trust. And REITs are really a great way where the average Joe, my name's Joe, the average Joe can invest in real estate with not that much money. So let's talk about that. So REITs, they are companies that own, operate, or finance income-producing properties, right? And so as a REIT, you invest in the REIT, and they will own, operate, or finance these properties. So not to get too technical, there are different REITs. There's publicly traded REITs, and that's all I'm talking about today, the publicly traded REITs. There are some privately traded REITs that are really for a select group and accredited investors. But I'm only talking about the publicly traded REITs. So there's different ways to categorize REITs. So there are those REITs, those companies that own and operate income-producing companies, income-producing properties. They own and operate. But there's also REITs that really, they finance the buying of those properties. And so these are really, those companies hold the mortgage for those income-producing properties. And then there are some REITs that are hybrid. They own and operate, and they finance, right? So those three, they own and operate, or they finance, or they do both. And there's different ways to well, let's talk about categorizing REITs as well. So in the commercial space, well, in the real estate space, we have residential property. Then we have commercial property. Well, commercial has different sectors, right? So we have office buildings, we have medical buildings, we have hospitality, which would be hotels. We have retail space, right? So there's a lot of different categories. So there are some REITs that diversify and own and operate or finance across all sectors of that income-producing property. But there are also REITs that specialize in each category. So I know there's one company called Prologis, looks just at industrial properties. And I don't want to recommend any stocks, so I really don't want to mention names. That's for you to research, right? But But there are, if you're interested just in hotels REITs, right? There are REITs just for hospitality, hotels just for medical. And then how do you invest? Well, there's a couple different ways. One is you can buy the individual stock of the company. I mentioned Prologis a second ago. Prologis is on the stock market. You can buy their shares. There are several companies that you can buy the individual stock. Or you could buy a mutual fund. I think there's close to 200 different REITs. And so you can buy a mutual fund just for the REIT you're interested in, whether it's category specific or if it's across the spectrum. But along with mutual funds are ETFs, exchange traded funds. There are REITs that are ETFs. Now, here's the benefit of owning a REIT. So let me do a non-example first, going back to my teaching days, right? Non-examples are as powerful as examples. So let's say I wanted to buy a house that I can turn around and rent. And then I say, you know what? I need money, so let me sell the house. Well, how long does it take to sell a house? Depending on the price and location and condition, it could take a couple months or 6 months, right? Well, so there's that liquidity issue. How fast can I get the money from the sale of the house? Well, mutual funds, stocks, ETFs can be traded that day. Now, the difference between mutual funds and ETFs and stocks, ETFs and stocks I can sell each moment. Mutual funds are usually closed at the end of the day. But it's within a day you can get the money out of the investment. So it is a very liquid as opposed to actually owning the real estate. Another benefit of owning REITs is, by definition, REITs are required to distribute 90% of their taxable income as dividends to shareholders. Let me say that again. REITs are required to distribute 90% of their taxable income as dividends to shareholders. So if a REIT is very successful, they're returning a lot of dividends to shareholders. Now, I saw a report that said REITs have outperformed the S&P 500 56% of the time. Well, okay, great. But let's face it, right? S&P goes up, it goes down, goes up, goes down. Same thing with stocks, same thing with REITs. So, but you can, in my mind, 56% of the time is, the return of REITs is about the same as S&P. That's just my thinking. Another benefit, you can get in cheaply. Now, you want to buy a house for $400,000 or apartment, a couple of $100,000. Well, with stocks or mutual funds, you can get in maybe for $500 or $1,000. Mutual funds will have a certain minimum you have to open. ETFs and stocks, you can just buy along the way. Also, REITs offer the ability to diversify. So go back to when I said that there are REITs that specialize in industrial or office. Well, you can certainly buy a REIT that diversifies across the sectors, but you can also specialize and say, okay, I'm going to buy this stock that's only industrial. Okay, now I'm only going to buy this stock that's healthcare. So you can create your own portfolio focused on the sectors you like. Yeah. So Now, are there risks associated with REITs? Yeah, absolutely. With any investment, right? Think about, when was it, 20 years ago, people buying Enron stock, and where's Enron now? Yeah, it's not around. So the people with Enron stock are left with nothing. So there's always a risk. So there is that market volatility. Stock prices, whether it's ETFs or stocks or even mutual funds, the value fluctuates. Now, the hope is over time, you get the return, right? That's the hope with any investment. The REITs and real estate is really sensitive to interest rates. And I've talked about this on this channel for a long time, right? If interest rates go up, if mortgage rates go up, it impacts the borrowing cost of money. And so if the borrowing costs go up and a REIT company wants to buy more properties, well, they have to pay more, on that monthly service fee, the debt service, just because interest rates are higher. And that will impact how much money they have to distribute as dividends. So there's that give and take. So REITs are sensitive to interest rates. But also each sector can be impacted. So we've known for a while, go back to 2020 with COVID and the shutdown of that we experienced. And a lot of companies said, okay, you can work from home. And now companies are saying, you know what? Yeah, continue working from home. So they don't need as much office space. So right now in Tampa, the vacancy rate in office is 20%. So that means 20% vacant, which means 20% of the space is not income producing, which impacts how much the REIT can distribute in dividends. Also, I know that there's a REIT that specializes in government contracts, right? They only, this REIT owns buildings and only leases to government entities. Well, if you followed the news lately, they're canceling a lot of these contracts. So is this REIT going to be affected? I would think so, right? It's very, again, volatile. The benefits, in my mind, outweigh the risk because there's risk in any investment. But it's a great way to get into the real estate market, start earning some of those dividends. If you're able to do it, it's called a DRIP, which is a dividend reinvestment plan. So all the money paid as dividends just goes to purchase more shares. And so over time, your ownership in that REIT keeps increasing, which increases the amount of dividends, which increases the amount of shares, right? And if you're able to do that. So check out REITs. There's a website called NAREIT.com, National Association of REITs, NAREIT. It lists a lot of REITs. It gives performance background. You can go to Morningside, go to any of the investment sites and research REITs. Do your own research. See which one fits you. If you're not sure, talk to a financial advisor and just start getting your money working for you. Okay, it's that passive income, which is really what we want to get to. Anyway, I hope this was informative for you. If you have questions, reach out to me. This is my commercial website, joebrown-commercial.c21.com. There's a contact me button. You can see my listings. You can see other listings. Reach out to me. Let's see if we can work together, okay? Until next week, take care.